So good evening, everyone. Welcome to the next session of your financial management. And today's discussion would be based on numerical topics of CAPM. The majority part which will cover up, that is the last portion about your CAPM part. Okay. Now, in the last class, I think we have discussed about the investment analysis. We have discussed about in depth about what is investment, its different characteristics. We have also discussed about the classification of investments in the last class and the different evaluation of this investment based on its instrumentation, institution, and the market. I think that was the part we have covered up. We have also discussed about the difference between investment and the speculation. Along with that, different types of investment alternatives as well. Okay, when it comes to non-marketable and marketable securities. Fine. Then we have also covered up about the types of investors in the last class. Then types of investors based on level of research and the common errors which is being committed by the investors in the market when it comes to the investment planning. Okay. Now today's topic which we have to start. This topic we also covered up in the last class, that is about the systematic risk and unsystematic risk. Okay. Now the measurement of risk which we need to start now. That is the numerical part of this particular topic. Now, when we discuss about how a particular company can measure the risk measurement having this following method, which includes standard deviation, SHARPE ratio method, beta valuation, value at risk, R-square method, volatility method, and probability distribution method. But due to the constraint of the timing, definitely I'll discuss only few methods of this particular topic. Okay. Now, the first method, I'll just go through with the brief first, what these methods are all about. The first method is called your standard deviation method to calculate the risk of any portfolio or risk of any investment. Okay. Basically, standard deviation will guide you about the variation in the expected return. Always remember, higher the standard deviation, higher the volatility of the prices, and higher would be the risk potential or the risk, you could say, assessment of any investment option. So always remember, when we talk about standard deviation should be as minimum as possible when we are analyzing, when we are assessing any security. Okay. Second part, the second method under measurement of risk is called the SHARPE ratio. Okay. The SHARPE ratio is basically nothing but whenever we want to assess any security option by keeping aside risk-free return, because under SHARPE ratio, we are actually focusing on the unsystematic risk. Okay, because unsystematic risk, which is non-diversifiable in nature, and how the company or how the investor can manage their non-diversifiable risk. Okay, so that is the part of your SHARPE ratio. Because these are the topics. In detail, if we talk about, these are very technical and lengthy topics. But due to the constraint of your syllabus and the timing, we are only discussing the brief about what these methods are all about. So whenever we are focusing on risk proportion or the risk assessment of any investment, we always calculate the SHARPE ratio. And SHARPE ratio will guide you whether the investment is risky, less risky, or having the moderate risk when it comes to the price fluctuation. I hope it is clear, SHARPE ratio as well, everyone? Yes. The next part we have that is the beta risk now. Now, beta risk is basically the assessment of market risk, or you could say systematic risk. So whenever we are assessing the non-diversifiable risk, or you could say inherent risk of any stock or an investment option, these type of, you could say, risk assessment is called your beta risk. Okay. This beta risk is basically measure the volatility, the price movement, and stock assessment. Now, volatility when it comes to the fluctuation in the prices of any share. So that will come under category of your beta risk calculation. Okay. And beta risk basically is one of the most important parts for any portfolio analysis. Or even if you remember, when we were discussing about the CAPM model, okay, in the CAPM model as well, the formula consists of beta risk as well. Because beta calculation is very, very important, even though the numerical which we'll discuss today as well, in this, the beta component is very, very important. Because the beta is high, definitely your investment is very, very risky. Beta should be less than 1 always. Beta should always be less than 1 in order to keep your portfolio risk on an optimum level, or you could say on a minimum level. So always remember, whenever we are assessing any beta component or the beta risk, the important thing is that the beta should be under, you could say under certain management, or you could say whenever we are assessing any portfolio or any investment option, the beta risk or systematic risk always play very vital part in assessment of the systematic risk. Is it clear? And beta will always reflect you about systematic risk of any investment or the portfolio. Is it clear, please, everyone?
Yes, sir.
Thank you. Next one is VAR, value at risk. Okay. Now, value at risk is all about when we talk about the market value or market value of any company or any, you could say, organization. In such a case, what is the capital amount which is at risk? For example, recently you can see that Tesla has actually lose its capital or lose its, you could say, number one tag of richest person or richest category because of the market fluctuation. If your stocks are not performing as per direction of the market movement, definitely you will lose your wealth. And losing the wealth means you are using the value of the company. Value at risk or VAR is basically the component in which the risk of the company or the valuation of the company may be at risk because of the price fluctuation. That is called the VAR percentage. Like for example, if the company having 10 lakh rupees of capital or 10 lakh rupees of value right now, what is the capital or what is the value? Like for example, 2 lakhs is at risk right now. So 2 lakhs would be basically the risk-based value, and the value at risk would be on 2 lakh rupees only. Now, up to in 2 lakh rupees, up to what extent the company may lose their money. That is called VAR. Is this clear, please, everyone? VAR. Hanji.
Yes, sir.
Yes, sure. Next one is R squared. Now, R squared is basically a statistical tool in which it will assess your portfolio in terms of percentage. Okay, from 0 to 100. If it is close to 100, it is high risk. It is close to 0, it is low risk. Please try to understand. I am just discussing a brief or a snapshot of all the methods. In detail, if you want to go through it, definitely you can refer any book or any online reference for all such things. Okay. That is not required. Now we'll discuss about this beta component directly now. Okay. The assessment of systematic risk, that is called beta. Okay. So always remember, as I told you, the beta is basically the market risk. Higher the beta, higher the market risk would be there, or higher the risk profile of an investment would be. Okay. And beta risk always assess the volatility of the price movement. If the beta is higher, the prices are more volatile. The beta is lower, prices are less volatile, or there is less chances or less risk when it comes to the price movement of any security. Now, there are certain formulas of beta now. You can see, note it down. These last two formulas, please. The beta equal to covariance of individual security with market portfolio upon variance of market portfolio. Second formula is standard deviation of security into correlation of return on individual security into market portfolio divided by standard deviation of the market portfolio. Please note down the formulas now, and then we'll start the numerical part. Because first of all, we'll write down all the formulas of this particular topic, and then we'll start. Okay, please note down fast. Yes, you note it down, please. Yeah. Now you
Completed,
can
sir.
see that when we will assess the beta calculation, always remember when the beta value is 0, when there is no risk of portfolio. When the beta is equal to 1, it is average level of risk, or you get a same risk profile as the market. Means what the market risk is all about, that your portfolio also possess same level of risk. When the beta is less than 1, your stock is conservative and less sensitive. When the beta is more than 1, your stock is more sensitive. Or you could say when we talk about aggressive stock, we could say more about the equity investment, okay, or ELSS scheme, okay. So every stock which is aggressive in nature, more in equity, more based on market condition, is all about your beta is greater than 1. So it is high risk, less risk, average risk, and no risk. Please note down fast, because this is the assessment of beta we have. And whenever we conclude, whenever we could say put some suggestions, that is always based on this beta assessment only. Clear? Hanji, done, everyone?
Clear, sir.
Yeah, sure. Now, assessment of risk and return. Basically, the next topic we have, whenever we talk about the risk and return profile, okay, it is very, very important that the risk profile should always match the condition. Like, for example, whenever we are assessing any risk and return profile, we always need to keep in mind about all these 6 basic parameters. Okay. The first one is length of maturity, means time horizon for which you are actually investing your money into the market. The credit worthiness of issued security, means up to what extent your principal amount is safe. Nature of instrument, whether it is government, corporate, or we could say it is more of ownership based security. This is called equity based security. Liquidity, up to what extent, when we talk about when you want to encash, how easily it could be encashed or how easily it could be converted into the form of cash. The assessment of macro factor as well, which includes your economic factor, industry profile, domain. Domain means any sectoral analysis, or we can say any political risk we have. And the last one is the yield and capital appreciation, which you will generate out of your total investment. So these are the major, you could say, assessment of your risk and return profile. I hope so very simple it is. Theoretical part, I think. Yes, is it clear now, everyone? Yes. So next part we have about the determinants of rate of return. Okay. First of all, when there are basically 2 types of returns. First is risk-free rate of return, means the assured return which you will generate out of it. Second is expected rate of inflation. Inflation means whenever you want to earn certain return out of it, definitely you always want to invest your money in such a manner so that you can beat the inflation. So always remember, whenever you are investing in any security or any option, it is very, very important that you always must have to beat the inflation. Okay. And the last part is risk associated with investment, which is unique to investment. Like, for example, there are certain type of risks which are associated to a particular sector only. For example, automobile, telecommunication, manufacturing sector. So any risk which is unique to a particular industry or a sector is called your risk associated with investment, which is unique to a particular category. And the formula for expected return would be risk-free return, the first one, plus inflation premium, plus any risk associated with the particular sector. Clear? Yes, been done, I think. The formula for expected return.
Yes, sir. Done.
Yes. Now, there are certain formula. I think if you remember this formula, return on individual security, if you need to calculate, the formula is alpha of security plus beta of security into RN, that is market return, plus EI, that is random error. Okay. Please note on the formula as well. And second formula is return on portfolio. Okay. That is risk-free return plus beta into RM minus RF.
What is RF?
Risk-free return. RF is risk-free return. Because when we need to calculate the return on individual security, that's the first formula, and on portfolio, that is second formula. This formula basically is CAPM model, make sure, capital asset pricing model. Yes, done everyone, I think. We will start the first basic numerical of this question. Okay.
Okay, sir.
Shall we start?
Done, sir.
Fine. First basic question now. Calculate the expected rate of return of portfolio. Expected market return given to you, risk-free return given to you, standard deviation is also given to you, and market standard deviation is also given to you. Along with that, correlation coefficient of portfolio is also given to you, that is 0.9. Okay, please note down these values and then I'll explain you how to solve this question, please. Because now it's all about numerical part. Okay, so be ready with your calculators and your notebooks, please. Hanji, note it down, please. All the values. Hanji.
Yes.
Yeah, sure. Now you can see that very simple question. First of all, we'll use this particular formula. If you can see that it is given in this first case. Okay, that is standard deviation. Sorry. Yeah, this formula. Okay, standard deviation of the security into correlation divided by standard deviation of market portfolio. Okay, so we'll apply this formula over here. You can see that standard deviation of the particular individual security is given to you, which is 2.4%, means 0.024, into correlation is 0.9 divided by standard deviation of market portfolio, that is 2%, 0.02. You will get beta value is 1.08. Now what is 1.08 indicates over here? That your stock is comparatively risky as compared to average risk, or you could say more risky as compared to the average risk of the market. You remember, I think beta is 1, beta less than 1, beta more than 1. Yes, students?
Yes, sir.
Yes. Now we need to calculate the second part of this, return on individual security. The formula is alpha plus beta into RM plus EI. Okay, so you can see that first of all. Alpha is 9%, risk-free rate of return, that is alpha 0.09, plus beta 1.08 into EI is not given to you, but RM is given to you, that is 0.15. So that would be 15%, 0.15 expected market return. Okay, so that would be 25.2%. That is return on individual security by keeping in consideration beta risk and alpha risk. Alpha risk is basically risk-free return. That is 9%. But considering the beta, higher the risk, higher the return, so it will give you a return of around 25.2% when the beta is 1.08. Clear? Anji, clear?
Yes, sir.
Yeah, sure. And the last part we have in this question, that is ER equal to expected return is equal to risk-free return plus beta into RM minus RF. You know RF, you know beta, you know RM as well. Put up the values, please, and solve the answer. You will get 15.48. Please always remember, the important part in these questions are not about solving the question, just to understand the concept about what is beta, what is alpha, what is RM, significance of beta, everything you need to understand and learn from the conceptual point of view, not from the solution point of view. Okay, very important. Clear? Any doubt, any query to anyone in calculation, in formulas, in assessment, interpretation? Hanji, clear everyone? If it is clear, then we'll move to the next part of this particular topic. Shall we start?
Yes, sir.
Yeah, sure. Now, I think this is the not part of your secure ROR return on equity. Shall I teach you or not? No. This we have covered up. Now we'll discuss about CAPM model, which is a very important part. Okay, and its numerical. Okay, that we also covered up already in the last class about what is CAPM model and its formula. No. 1 minute. Okay, students. So we'll start this particular part, the question of CAPM model now. Okay. That is capital assist pricing model. The formula for the same we have already discussed. That is expected return equal to risk-free return plus beta into market return minus risk-free return. Okay. One more question now. Dummy Limited, an investment company, has invested in equity shares of a blue chip company. Its RF is 10%, RM is 16%, beta is 1.5. Now, what is 1.5 indicate? The stock is aggressive stock. It is high risk stock because beta is greater than 1. Please calculate the values now. It should be 19% now. You can see that the market return is 16. And whenever your beta is greater than 1, your expected return should always be higher than the market return. As you can see, the answer is 19%. Okay. Risk-free is 10. But out of the market return, if you are just actually digesting, if you are exposed to the higher risk, definitely you will generate higher return, more than the market or average return of the market. Clear? Everyone, please note it down. Because this is a very basic question we are solving right now. We'll just go with some advanced question as well after break. Okay. So very simple question, but important thing again, I'm telling you, it's not about solution. It's all about how you are actually understanding the concept of this particular topic. That is CAPM model. Hanji. Please note down fast. Yes, students, clear this one? 19%. Hanji. Everyone, please kindly confirm. Is this clear?
Yes, sir.
Yeah. I think this is also a simple question. I'm not going to discuss right now. Yes. Now we need to discuss this growth of the stock. Yeah. First of all, I think if you remember the calculation of cost of capital, we discuss all those formulas. But still, you can do one thing. Whenever we have the growth of the stock is given to you, how the CAPM model will work. Please note on this formula first, and then we'll discuss. Here, the D0 is the current year dividend. D1 is the next year dividend. P0 is the price of the share. ER is the expected return. G is the growth rate of the stock. Clear? Please note down this formula, and then we'll start the first numerical when the growth of the stock is also given in the question. Clear? Hanji, done everyone with the formulas? Hanji. Yes, friends, please kindly confirm. Is this clear?
Yes, sir. Yes, sir.
Yeah, sure. The first question, you can see that Chicago Corporation stock will pay a dividend of $1.32 next year. So D1 is given to you. Next year dividend. Its current price is 24.625 per share, means P0 is given to you. The beta is 1.35, means it is an aggressive stock, high risk stock. Okay. Expected market return is 13.57%. ERM is given to you. If the risk-free rate is 8.2, we need to talk about the growth of a particular share. Okay, how to calculate first? First of all, in order to calculate the growth, we required ER, D1 and P0. P0 we already have, D1 we already have. We need to calculate the expected return first. So the formula for that is RF plus beta into RM minus RF. What is RF? 8.2% plus beta 1.35 into RM 13.5% minus RF is 8.2%. You will get 15.35% as ER. You have ER, you have D1, you have P0. You can calculate growth. This should be 10%. Please do it. Whether you're getting the answer or not, please do let me know. First of all, complete till ER, then put up all this value in the formula. You will get the value of G. Do let me know whether you're getting the answer or not. Because it's very simple. We'll go for P0 is 24.625 is equals to D1 1.32 divided by ER expected return 15.35, so 0.1535 minus RF risk free return, that is 0.082. Clear? You will get 10% answer. Do it fast and do let me know, is there any query in this particular question and are you getting the answer of 10% or not? 1 minute.
Yes, students.
Please explain again ER, how to calculate ER.
Yeah, the formula is RF plus beta into RM minus RF. Risk return is given to you in the question 8.2%. You can see that. Plus beta 1.35 into RM, market return 13.5 minus 8.2.
Sir, please show the 98 slide.
Which slide? 98.
98.
Yes, this is not in syllabus actually. I'm not covering that part. See, I have lot many things to discuss actually. CML, SML. but as these things are not in your syllabus, so I'm not going to discuss those.
Okay, sir.
Okay. Yes. Because the major part we have in your syllabus is CAPM model and its numericals. Hanji, got this answer please? 10%, everyone? Because now we have to do numericals only in this session, okay? Is this clear, everyone? Growth rate is 10%. It should be the answer.
Sir, clear.
Clear? Okay.
Yes, sir.
Yeah, sure. I think that I have completely explained it. Fine. Okay. See, this is the next question now. The answer of this question should be 18.9 and P0 should be 7.75. Okay, in this question, beta is given to you 1.15. Dividend is $1. Okay, that is next year dividend. D1 is given to you. Growth rate is given now this time. Now in this question, previous question, the growth rate was not given and P0 was given. Now in this question, growth rate is given, but P0 is asked in this question. Okay. The risk free return 12% and market return 18%. Simple, similar question, I think so. Go for ER and P0 first. First, go for ER calculation. Like similar question, this is just go for ER and P0 calculation, please. Yes, student. Anyone got the answer? ER is 18.9. Yes, yes, good. And it is 7.75. Done, please, everyone.
Okay, sir.
Okay. This is the answer. You can see that ER is, the formula is, that is 0.12 plus 1.15 into 0.18 minus 0.12. You will get 18.9%. Okay. And growth should be 6% given to you. So you will get for P0 calculation. The P0 would be $7.75.
Done, sir.
Done, everyone? Sure, good. So we are taking a break of 5 minutes now, and we'll get back to you at 6:05 sharp. And we'll discuss few more questions now. Clear? Okay.
All right.
Thank you so much. Yes, student. We'll start now. Okay. The next question. Fine. So, is this question done now? I think. Fine. Yeah. We'll do the next question now. Okay. Now, in this case, you can see that the beta of a company is 1.15, growth rate is 10%, and dividend of next year D1 is 3 rupees. Sorry, 3 per dollar. Okay. Common stock sell at 50 per share. That is about the price of share is given to you. Risk-free rate is 8%. It is also given to you. Okay. Along with that, by carefully planning and by selecting more, you could say more secure project, Vegas has reduced its risk. Its new beta is estimated to be 1, while everything else is same. What is the new value? First of all, what we have to do with the given data, we need to calculate the expected return of the market. Okay. First of all, with the given data, we need to calculate the expected return of the market. Okay. So first of all, go for this calculation. Okay. As you can see this answer as well. The formula for returns is upon D1 upon P0 plus G. I think if you remember, when we discuss about the price, leverage chapter, okay, and the cost of capital as well. At the time we discuss about the equity share growth, D1 upon P0 plus G, you will get the ER is 16%. Expected return of the market is 16%. Okay, then we'll apply the formula. ER equals to R plus beta, ERM minus R. Okay, so what we'll do now, we'll just simply put up all these values and we'll calculate for ERM. We'll calculate for ERM. So what is ERM formula? You will just convert this formula into ERM. You will get the value of ERM first. Okay, so that should be 14.96. See, go step by step. First of all, go for calculation of expected return. That is ER. That is D1 upon P0 plus growth rate. D1 is 3, P0 is 50, growth rate is 10%. Is the first part clear? How it is 16%? Is this first part clear? How the 16% came?
Yes, sir, clear.
Yeah, sure. Now, after that, now we have ER is available, R is available, beta available. We need to calculate ERM. So we can definitely calculate. So ERM should be 14.96%. Go for this calculation now, please. 14.96%. Yes, everyone got the answer. 14.96%.
Yes, sir. Got.
Okay, now the second part of this question is when the beta is equals to 1. Now, as you remember, that if the beta is equals to 1, means your expected return in the market then would be similar. Your expected return in the market would be similar because the risk of the particular portfolio or the investment would be similar to the particular risk of the market. So in such a case, that would be ER equals to ERM, that is 14.96%. So now we need to calculate new price of the share. When the beta is equals to 1. Beta is equals to 1 means it is equal to, okay, so in such a case, your price should be dividend upon your ERM is 14.96 minus risk return. That is,
Sir, your voice is not clear.
my voice is not clear. Now it's clear, please kindly confirm.
Yes, sir.
See, always remember when beta is equals to 1, it means that the stock is performing at the average market return. It means that your acquired return should always be equal to the market return. So that's why ER is equal to ERM. Okay, that is 14.96%. Now, when we need to calculate the new P0, new price of the share, when the beta is equals to 1, because the price of the share which is given in the previous part was for beta 1.15. Okay. Now the beta is 1 means your stock return is equals to market return. In such a case, the new price would be $60.53. $60.53. Okay. I hope so. Now it's clear. Yes, student. Is this clear?
Sir, once again.
Which part?
P0. Last.
P0. See, last one basically when the beta is equals to 1, it means that your expected return is equals to market return. So in that case, your ERM should be 14.96%. Okay. So P0 formula is, you can see the formula right now, I think in the on the screen. 1 upon 1 minute. P0 is D1 upon R minus G. Okay. So that same formula we applied over here. D1 upon R minus G. That is D1 is $3. R is the return, market return 14.96 minus risk-free return is 10%.
Okay, sir. Thank you.
That should be $60.53. Why the price
Okay,
changes?
sir.
Because the beta changes. Clear, everyone? Haji, done everyone? Shall we start the next numerical now?
Yes, sir.
Yes. Now just try this, I think, whether you are able to do it or not. Because in this question, we need to calculate beta. Just try this question once, please. Okay. The answer of this question is actually, first of all, you need to go for ER, which is 10%. Then beta is 0.67. And then the price is 125, beta is 0.63. Okay. So these are the answers we have. But first of all, please calculate at your end. Okay. Then I'll show you how to do this. Yes, anyone got the answer? The first answer, first of all, please, step by step. ER is 10%. Because P0 is given to you, RM is given to you, RF is given to you, D1 is given to you. We have to go for ER and beta first. Haji, anyone got the answer, please? ER is 10, beta is 0.67. Yes, student, done. Please kindly confirm. Expected return 10%. Then from expected return, you will go for beta calculation, it is 0.67. And when the price changes, beta is 0.63. See, students, it's all about formula. Okay, try to understand. The calculation I have already shown you, I think, yeah, this is the calculation you have, okay? 0.667, when the price changes, and the beta is 0.633. So this topic is all about formula based. Okay, you need to apply the formula and you will definitely get the values. Hanji, done? Everyone? Because
Okay, sir.
I'll share one practice sheet with you of all these topics. Okay, so go through the practice sheet and of this particular topic, CAPM model. Okay.
Okay.
So because we are almost on the verge to complete the syllabus, because hardly 1 or 2 topics are left. Okay. So that will cover up in tomorrow's last class of financial management and doubt things is now correct. Clear? Hanji.
Hello, sir.
Yes, tell me, Mr. Kamal.
Sir, would you please confirm ki most important chapter for finance management?
See, you can go for capital budgeting, cost of
Okay.
capital, leverages,
Okay.
leverages. Yes, and time value of money, I think initially we discussed.
Okay.
Yeah, so the major 4 or 5 topics are important.
Okay. Please suggest any specific book.
See, regarding book, I think M.Y. Khan, if you can pick, it's good one.
Sorry?
M.Y. Khan.
N by Khan.
Yes.
Okay, sir. Okay. Thank you.
Yes.
Okay.
So, any more doubt, any more query to anyone, please? From this CAPM model and its numericals? Because I'll share the practice sheet of all this particular topic. Okay, CAPM model. So I'll mail to the institute. They will also mail you this particular practice questions. Anji. Is there any query to anyone, please?
No query, sir.
Okay, Isha. Thank you so much. So shall we sign up for the day then? And tomorrow we have a last session on dividend policy and other topics. Okay.
Okay, sir. Thank you.
Yes, sir. Thank you very much.
Thank you so much.
Thank you.
Yeah, thank you so much.